Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is December 1st of 2020. And yes, congratulate everyone out there. We've made it to December. So only about 30 plus days left, including today, to the new year. But we have to get through December 1st. Let's look at the history books real quick and what markets are paying attention and what history tells us about how December setup leads us into December's performance. So let's watch the updates of the day. Thanks for watching. So I just said yesterday, November is a historic November to remember, right? Dow 30,000, first time ever, and who would have thought in the midst of a global pandemic and everything else, 2020 has brought to the forefront, and we are looking again to next year. But you can't get there without getting through the month of December. Today, trading day, markets are up substantially right now as I film this. And let's continue to see what history says as it relates to a November positive. Since 1950, the sample set that we looked at as it relates to the S&P 500, this past November, so just yesterday, and the month finished at a 10.8% up for the S&P 500, which is the number one first place for the best performing November since 1950. That, historically speaking, puts into perspective, well, what does that mean for December? Because it's not what have you done for me lately, what will you do for me going forward, oftentimes in the investment management world. So we look to history as a guide as it relates to, history doesn't always predict the future. Again, this is, we're looking at some scientific past, if you will, as it relates to technical analysis and research that really helps us set up and be a guide for the future. Again, anything can happen, as we all know. But that being said, it actually is a very positive. If a November as strong as it was, and when we say strength, we're talking about 93% of the S&P 500 stocks were above the 200-day moving average. Not to get too technical on all of us, but the moving average, there's the 50-day, which is the short term, and the 200-day, which is the long-term moving averages. And those are both sort of trend lines that technical analysis we here at Blanke Schein Wealth Management follow, both on the indices and individual equities that we follow. Those are very important indicators. In this case, over 93% of the index are well over their 200-day moving averages. That's a net, huge take-home positive. Is the market overbought? We would say by this standpoint, it is severely overbought, but that's always not necessarily a bad thing, because there's some rotation that we're going to see, or some consolidation that we're going to see moving forward. Remember when I said early on, if you follow me, it's moving up a mountain. And if the Schein family got, my wife and I have 4 teenagers, and so the younger ones run way ahead of us. Those are different sectors. Each one of us represent a different sector. And so as they run ahead of us, we all have to get to the mountain together at the top. So what has to happen is they have to wait for mom, or specifically dad in this case, to catch up, because I'm usually the last as we go up the mountain. So the kids have to stop. They have to come back down sort of where we are as we inch our way up the mountain and consolidate. So those are different sectors. So some of the technology sectors have run ahead early on this year, and they sort of taken a breather in the last month or so, while other sectors like financials and energy have sort of, again, that would be me, sort of work our way back to the consolidation or a broadening of the market rally, if you will, or just strength to the overall marketplace. Why we know that's the case? Because we look at the indicators, as I pointed before. It's not just some one sector of the economy or one subsector of the market that's leading the way. It's a broadening and a consolidation. So this overbought and consolidation in the month of December, if you will, is not to be unexpected. It's to be expected, but it's welcomed, because we need that consolidation to make higher highs going forward. Because again, November just brought us 30,000 on the Dow Jones Industrial Average. So here's another statistical point of history that we looked at this morning in our morning research, that when we have a November this strong, moving averages above 90% and such, there's a 70+% that December will be positive. In those 3 sort of December months out of that subset that we looked at, with this setup here, we only had a December that was down 3.4%, negative 0.1%, and negative 2.2%. So even the consolidation wasn't that great. We could see a sell-off maybe mid-December, maybe even early January if we have more election sort of questions as it relates to the Senate. Remember, Georgia, we have to keep our eyes on. So that would be expected. That being said, those are viable market opportunities right now, as we see here at Blanke Schein Wealth Management. So that's our setup for right now. November to remember, into December. December's off to the races, but it's a broadening market. It is overbought in some sectors, but there's tremendous value built in. Again, disconnect to the regular economy and the real economy, and we'll talk about that a little bit later. So another question is, Rob, how do you have so much conviction as you did since March that the market, the economy, and a lot of things are going to be okay? Again, I go back to our research. We spent a lot of time, effort, energy, hours upon 24 hours a day. Our team here at Blanke Schein Wealth Management looks at all of the research that's out there, and consensus or contrarian, we kind of create our own house view internally, and then again I report that to you basically on a daily basis as to what our thoughts are, what we're thinking. And one of the key indications that we always look at the dashboard of concern, right? The one thing that we know that the market is based upon the economy, but is the economy healing? Is it getting better? Well, two factors. Number one, globally, economically speaking, like China, again, they just had another report that was globally just on fire in terms of growth in their economy. Again, they were ahead of the coronavirus, and so now they're crawling out, if you will. Not even that. They're accelerating. They're breaking all records. So their economy is really expanding and growing right now in the midst of this, right? So that's number one. Globally speaking, those countries that are ahead of us, are they surviving? Are they regressing with the second wave? And the market is watching this. And although the media is saying a second wave and we're all have to miss Thanksgiving and Christmas and New Year's and probably all of 2021, if you watch all of our media, they never want us to leave our houses. I get it. Even with the vaccine, it won't be good enough. It won't be what they want. It'll be disappointing. Honest to God, that's why I'm going to my daily updates, because they've been so successful. Because the media is saying one thing, it's a completely different narrative. The market is showing us that, listen, let's look towards the global world. They're surviving. They're thriving. Also the mortality rate, the more cases you have, the more testing you do, the more people that are surviving because we have vaccines coming on, because we have therapeutics, the medical community, so on and so forth, is learning to deal with it differently. The survivability rate of this is growing tremendously day by day by day. So that's a positive. That's a net positive we should all be happy about. And again, we have vaccines coming in 2021. That being said, between now and then, how does this really look? We look globally, as we said, but more importantly, here in the United States, we look at the 10-year Treasury. The 10-year Treasury is a sign of stress. Also the VIX. And the VIX just actually coincidentally had a VIX is a volatility index. It shows a sign of stress or concern that's building up in the market. That's how we know how to position portfolios accordingly, both on the short term and long term. Right now, the VIX had a lowest low since February this year before the coronavirus. No one would ever guess that. You would think that we'd still have heightened concern, heightened worry. Again, markets are seeing things differently than what the media and the financial press is actually reporting. Again, that's why the success of my daily updates have been taking off. So I appreciate your support, because we're just reporting what markets are paying attention to, and that may or may not be reported on a daily basis. So we look at the 10-year Treasury here in the United States, and that's turned the corner. We had lows this summer, but not to say we're going to have 10-year Treasury take off on us, but there is support there, and the key to turning the corner is having the support first and foremost. We could see some consolidation, but it's going to break out to higher highs, not immediately and not like significantly, but as long as we turn the corner, if you will, and we've got sort of positive momentum, not only here in the US, but Germany and Japan, they're also seeing this. So we're looking at other sort of equivalents of the 10-year Treasury. Okay, the sovereign debt, and it's improving. Debt is the most important thing as we pay attention to as it relates to the equity markets, because the debt markets here, United States, both on our treasury, but in our national debt, but also around the world, that's the largest market in the world. The stocks is, equities are a sideshow. It's really small in comparison. So the stress really comes down to the fixed income markets, and they're healing, they're getting better, they're showing signs of strength. That's where we get the conviction to the equity markets, and that's where you're seeing the empirical evidence that's showing the equity markets are not up just by 10.8% in the month of November for no reason. That is the reason. Economies are healing, signs of strength. Now, we'll see if we get Coronavirus 2.0 Act, because small businesses, there's a disconnect between Main Street and Wall Street, because the companies that are publicly traded have access to capital, have the ability to sort of stay open, and that's the name of the game right now, is you survive. If you survive, you will thrive, because all your competitors are out of business. So hopefully we, number one, stay home, shop small businesses, support small businesses for this Christmas holiday, shop local restaurants when you can get out, if you can get out, and support local restaurants, because they need us. The hospitality industry needs us, because those companies need to, those little small businesses need to survive. That's the disconnect between the markets and sort of Wall Street and the economy. So that could be the bridge that we're going to pay attention to as we get into the coming year, and that's the concern we would have to be most paying attention to as we move along in the month of December. But in the meantime, well, wonderful November. We're starting off December right. Thanks for staying with me today. It's a little bit longer edition, but I think it was worth it because I wanted to explain some things that are really important as it relates to investment management, what markets are paying attention to, what our thoughts are versus what the headlines are actually giving you on a daily basis. Thanks for watching, and we'll see you again next time.